Good morning, everybody. This is Mortgage Post 411. I am Audrey Boissonou with my co-host Kevin Casey, and we are joined today by Mr. Dave Stevens. Hi, Dave. Always good to see you. How are you?
Good, Audrey. Hey, Kevin. Good to be with you guys.
Just to recap some of Dave's accomplishments, things he has done, reasons we think he is incredibly credible. Let's start with the fact that he started as an LO just like us. So not only does he know his way around the trenches, he also did things like, I don't know, run FHA, advise a president, run MBA. So he has been very prolific, Dave. You have said a lot of things recently in writing, in the media, that maybe not everyone agrees with. So I'm super excited to get into some of that. Makes me happy. But first, I just want to take a moment and let you know that on Thursday, we're going to have pending home sales. And then Friday, Fed's favorite measure of inflation, PCE. I feel like maybe just because we're talking about it all the time, but I feel like the PCE, CPI, all the inflation numbers are coming out every 15 seconds. I think it's just because it's such a part of like Jerome Powell speaking in front of the Senate and the House last week. And, all this. And just for the record, Dave, about a month or two ago, decided that we were going to make the word recession a drinking game. So every time you say the R word, you have to take a shot. All right. If you're still standing at the end of the hour, good for you. But the rest of us can't make it that far. So we've been trying to minimize the talk of such things. So with that, we are, where should we start? Why don't we just dive in with what you think should happen with FHFA, with the GSEs and conservatorship. Tell us a little bit about the article that you wrote, the opinion piece you wrote for Housing Wire, and what made you round the corner on this?
Well, yeah. So, look, I've been around the conservatorship from the very beginning, right? Because they went into conservatorship in 2008, along with the HERA legislation. And I walked in to be on the housing team for the president in early 2009. And so we spent a lot of time talking about what to do with these two companies. Back then, I don't think anybody envisioned what we're seeing today. And I'll just take the last two commissioners since they cover two different political parties. Mark Calabria, who was the director of the FHFA under President Trump, and Sandra Thompson, who's the director of the FHFA under Biden. And don't forget, we have now a Supreme Court ruling which says, screw the hell with the 5-year terms. They serve at the will of the president, which means their independence, I guess, is now a little more in question than it was when guys like Ed Demarco and Mel Watt ran the FHFA, again, both representing Republican and Democratic regimes. But I've watched the tinkering that's been going on with Fannie and Freddie, starting with Calabria. And I wrote many pieces against him at the time and what he was doing. And I've done the similar with Sandra. And I've known Sandra for a long time. And I've had a lot of pushback from guys in my party. I'm a Democrat, telling me, how can you do this? We need to support Democrats. And housing's not a political thing to me. Housing is about what's right for housing. And when they modified the LLPAs, there's more to it, obviously, getting, pricing them for 2 to 4s, high bal, cash outs, second homes, then modifying the LLPAs in a clear cross subsidy, which they then had the gall to try to deny that it was a cross subsidy when in fact it was. And I know you guys, it didn't mean a lot to you in real cost, that particular piece of the LLPA, especially once they got rid of the 40 DTI cap. But to me, it was all part of just a really bad story. It's the story of a FHFA director using the GSEs to achieve her political goals, which is to get more minorities in housing. And I applaud that effort, but hey, Guy, I applaud that effort, but I would just say, this is not the way to do it. And you all know it. The modifications they made to the LLPAs isn't changing a damn thing. In fact, for those low FICO, high LTV cells in the LLPA grid, I hate to say it, FHA is still cheaper. If you're in the right loan limit, then there's a reason why, FHA does 3 times the number of loans to Blacks and Hispanics than the GSEs do, and the FHA is only about a third of their size. So it causes me consternation in a similar way that it did when Calabria was running the FHFA, and he was doing his own odd approach. So my view is, I think we'd be. Hi, honey. I see you in the background. That's my wife walking around.
Hi, honey.
The thing I would just highlight is it's a lesser of evils. I always thought it would be best to do congressional reform of Fannie and Freddie to permanently make sure we wall off some of the aggressive lobbying tactics and bully pulpit tactics that they engaged in with the industry when they were truly independent companies. And for you guys who've known me for a long time, I ran Freddie Mac's single family business for almost a decade. I was an insider in that company pre-conservatorship. I know I was in the middle of the alliance deals that gave Wells Fargo the sweetest deal in the nation. Fannie gave Countrywide the same deal. I wanted to make sure that could never happen again. I thought legislation was the way to go. Reality is today, I think the regulators get that part. They don't like giving a few lenders intense power through pricing advantages. I can't say that's going to be that way forever without legislative reform, but I think we're more at risk with what's going on with the FHFA director, because if they start tinkering with pricing, and you're already seeing it, Audrey, you were telling me about a cash out refi you just closed over 8%. I mean, the reason why cash outs have gotten so damn expensive is the GSEs decided to add a bunch of fees for them.
Right.
And that's ridiculous, gang. I mean, a refi for a risk manager, and anybody who's a risk manager here, an underwriter knows, refis improve your performance expectations. They lower your expected default because you're putting that person in a better position financially through the refi. And so generally speaking, not in all cases, generally speaking, and yet we're charging all these fees.
Any particular statistic on whether a cash out refinance puts people in better position than just a rate and term?
Well, a cash out refinance using the limitations of the GSEs, where it really doesn't become, your LTV is low enough generally in a cash out refi that you still have equity protection in the home, but you're giving them liquidity to offset debt, student loan debt, auto loan debt, run their small business, whatever it may be that they need the money for, it's generally going to a better cause. So having to pay that much for a cash out refi or any refi is absurd to me. Same with second homes, by the way. Second homes generally have much larger down payments. They're generally to wealthier home buyers. They're usually in markets of high home price appreciation, whether they're coastal markets or mountain markets.
Yeah.
And in that regard, why are you charging more for these things? And then 2 to 4s. That's mom and pop rental property stuff. And suddenly you're hitting these guys with fees when in reality, show me where the default problem is in the 2 to 4 market.
Okay.
I don't get it.
So
Anyway.
you're on the inside, Dave. Maybe you will be my little view into what was really going on, because I've been arguing way before all this that the LLPAs were based on risk were complete bupkis, because if they were true, then you would have never had an add-on for a cash out refinance at 20%. It cannot possibly be more risky, or a refinance at all, frankly. It can't be more risky than an 80% purchase. That can't be true. Show me the algorithm. I've always been like, show me where it shows, show me the data. And no one has ever shown me the data. So did that data actually exist at Freddie? Like, did you have data on that? Were the LLPAs based on that? Or is it all a bunch of smoke and mirror crap that is just being expounded upon now?
Guys, the LLPA stuff only really came out post HERA.
Right.
And Demarco, and by the way, I called him out on this, but Demarco believed that having high LTV loans protected from a counterparty risk standpoint by an MI company wasn't satisfactory. That, an MI was typically a B-rated company.
Wow.
There are all various ratings there, but you had a AAA wrap from Freddie and Fannie's government guarantee being insured by a B-rated firm. Now, I'm not going to explain all this, why that's such stupid logic,
Wow.
but nevertheless, it doesn't matter. So Demarco testified that he couldn't trust the MIs to be there as a counterparty in the event of default. And by the way, we learned that, right? In the Great Recession of '08, a lot of MIs refused claims. But since then, we've had the national MI rule that the GSEs have now implemented, including tougher capital standards for the MIs. They are very different companies than they were back prior to 2008. Remember, a lot of MIs failed. PMI itself as a company failed, and others. But today we have the P. Myers rule, which is the name of the rule, PMIERS, that the FHFA endorsed and Fannie and Freddie approved. And that makes these guys far better counterparty entities. The reason why that's important is if you're charging 55 basis points as a guarantee fee, and forget sometimes the add-on fees for 2 to 4s and second homes and all that other stuff, but if you're charging 55 basis points for a base guarantee fee, and you've got a credit enhancement that's covering somewhere between 30 and 35% of the loss risk, depending on the initial LTV of the deal, that means your net LTV risk takes you down to about a 70, maybe a 65 LTV as Fannie and Freddie, because they've got first loss coverage by an MI company. That's not always the case. You can still do an 80-10-10. I don't know if anybody's doing many of those, but you can still do a piggyback. But and generally speaking, you have MI and you have a deep credit enhancement, which is covering your first loss. Why are you charging LLPAs? Right. So I sit on a group that just got formed through NHC, National Housing Conference. And in fact, it's a working group on the single family pricing framework. We have our second meeting tomorrow. And it's really all the policy guys inside the Beltway in Washington. NHC is a really well-known think tank. Steve O'Connor from the MBA sits on the board of the NHC, but the NHC is a really effective voice, and it's a little liberal-ish. So, they don't get yelled at by our senator from Massachusetts or whatever, but they get listened to because they represent all interested industry and policy guys all put together in a room. And I'm on this group tomorrow. They're advocating, they haven't quite said it yet, but I know what their point of view is, that LLPA should be eliminated.
Yes.
My own sense of this is that risk-based pricing structure makes no sense, because that lower cell that just got the boost from Sandra, that's got the same 35% credit enhancement that the borrower with the 720 FICO has. In other words, your equity risk is completely, almost eliminated through catastrophic loss levels, and yet you're still charging 225 basis points or 250, whatever the number is, depending on what cell you're in, for an additional fee. It makes no sense. It was put into place at a time when the MIs weren't as trustworthy. And frankly, I think some FHFA directors, particularly Demarco back in the day, had a very different view about capital and what the GSEs should have as front loss. So there's a big push right now, and you're going to see it grow and put heat on, particularly this administration, to try to reduce or eliminate LLPAs altogether. In fact, if you could argue, look, if you really think it's that important, just add 5 bips to the base G fee and call it a day, because that'll cross-pollinate all of your good loans and your less good loans, along with a credit enhancement from an MI company, and you'll eliminate all the risk to the GSEs without having to rip people off, which is really what I think is going on here right now.
Okay, so first of all, I think a few LOs heads just exploded. I don't think LOs in general think about risk quite as much as we should be thinking about risk. And so
that's true.
The new R word, the new drinking game on our little show will be anyway, but it's risk. So important we think about this, because it really trickles down to everything we do every day, right? And so
so when we think about risk, and I talked about credit enhancement, I'm sorry, that's MI, or putting a credit enhancement on it. There's also they're risk trading. The GSEs they're trading their portfolios. So even after it settles, they're risk trading in structured finance forms into the capital markets to reduce their credit risk. Right. But when you think of risk for GSE or lender, any of the companies you work for, you look at expected default. Now, expected default comes from things like LTV and FICO and borrower purpose. owner occupied, non-owner, et cetera. And so you can model expected loss. By the way, everybody models it, including
Right.
your companies, as well as the GSEs and Ginnie Mae, FHA, and everybody else. And then you have the second item, which is called severity risk. And so what you do is you first model what's the expected loss, and it's usually done in basis points. I don't want to confuse you, but you figure expected loss. Anyway, in terms of how that could impact your overall portfolio, you take and you run it through a variety of modeling variables. And then you look at severity risk, and severity risk is going to be higher on a high LTV loan than it will be a low LTV loan, because, if home prices drop 20% like they did in the Great Recession, and those models are still used today by risk managers, risk modelers, a home with 5% down, the negative equity will blow through their down payment. But when you add a credit enhancement, meaning MI or some other form of credit enhancement due to trading your credit risk on the secondary market, which is what Fannie and Freddie are doing, even though your expected loss might be high, your severity rate might be high, that is traded away to a third party. You don't take that hit.
Right.
And so, yeah, I can see the MIs charging risk-based pricing rate fees, which they do to you guys,
Right.
to your borrowers. You have to pay their fees, which depend on the MI structure. You do it a variety of different ways, but I get them because they're in first loss position.
Mhm.
The GSEs are not in first loss position.
Right.
So they can argue all day long about expected default and severity risk. They are not in first loss position. And if you cover first loss through what we call catastrophic level, we have a cat loss variable that you'll assign to any loan you do, typically around 70%, maybe 65 LTV. If you're insured through that on your entire book, what the hell are you charging LLPAs for?
Right.
You're double counting. You're charging it on top of MI. The borrower's getting charged twice for that same first loss risk protection. And only reasons that's there is because Ed Demarco, in testimony in front of the House Financial Services Committee, I've read his testimony a million times and spoken to him about it back when he was director, said that he didn't trust the MIs, so he had to charge his own fees because he didn't trust the MIs to be there to cover that first loss risk. That's why you have all this LLPA crap in the first place. So it's kind of crazy as you think about it.
But then again, if we go back to that space and time,
None of this is going to get you guys another loan today, by the way. We're just talking.
No.
you know what this is, though, is that these conversations are important because when it's time for us to weigh in as an industry and make our voices heard on a call to action that NBA or NAM or some other organization is putting forth, we need to respond and we need to understand the topics. And our clients are seeing these headlines in the news and they think they know something and they don't know crap. And so and
the other thing that, and Audrey, to your point, I mean, you're very senior leader in the National Association of Mortgage Brokers. And so NAM has a voice. California mortgage bankers, they're bankers,
Bakers.
the CMBA,
and then there's
Bakers.
California Association of Mortgage Professionals.
So they all have a voice, all the way up to the Mortgage Bankers Association in Washington, the Community Home Lenders Association. I mean, I appreciate the NBA going after trigger leads, and there'll be legislation, and we'll see where that goes. But they should be able to chew gum and scratch their head at the same time. They should be all over the GSEs for this pricing structure. Washington's MBA and all the state associations be advocating aggressively around double charging home buyers. I mean, for God's sake, we have rates in 7% today, and we're also hitting them with all these fees on a low down payment transaction. And all we have is Sandra Thompson tinkering with LLPAs in a very dysfunctional way, frankly, and then defending it as not a cross subsidy, which is completely insincere, a flat out lie, honestly. Pissed me off, and that's why I went at her publicly. And we're going at this all wrong. And in my article yesterday that I wrote in Housing Wire, you can read it, guys. I just published it yesterday about how I think housing policy in Washington is horrific. And you guys know this. We have supply chain shortages. The administration in Washington's doing nothing about it. and we have unaffordable mortgages, and yet we're tinkering with LLPA grids. You
Right.
want to help a minority first-time home buyer?
Lower the
Come
rate.
up with a buy down,
Yeah.
right? Give them a 2-1 or something buy down. Or as Bill Dallas is suggesting, let's create a hybrid ARM market. How would you do that right now? And there's no secondary market for ARMs.
Create a
Get the
secondary
Fed
market.
involved.
Yeah.
Or the Treasury window, get them involved. Or the Federal Home Loan Banks could create a window. I mean, it's not that complicated to come up with solutions. But why is that not happening? Because there's no organization focused on it. When I was in the administration, granted, you're not all Obama fans, but I worked for Obama. He created the housing team in 2009. It consisted of all the secretaries, the Treasury Secretary, Tim Geithner, Sean Donovan, the HUD Secretary, the head of the OMB, the White House Chief of Staff, the head of the National Economic Council, Larry Summers, the former Harvard president, head of the NEC when I was first there. We had meetings 3 or 4 times a week. We met with the president every 3 weeks on what topic? Housing. Housing issues were made interregulatory. It was a major focus of the administration because we were in a housing crisis brought on by the Great Recession. If people think we're not in a housing crisis now, they're friggin' insane.
Right.
The only guys who can buy homes today are people with money who look a lot whiter than everybody else. And we've got real challenges because of what the Fed has done to the interest rate market and the supply chain shortages. I can't share my screen, can I, Audrey?
Oh,
No.
please
She
hold.
can-
I
she
know
can
how to
make
do that.
happen.
Yes, I can do that. Please.
I just want to show you one slide, which I put in my article.
Okay, it should be good.
And let me just share this one with you. Hold on. So this is, Mike Frantoni's using this slide too, by the way. This is all housing stocks built by year, going back prior to the early 1930s, okay? So it's in cohorts, 1939 or earlier on the far left, 1940 to 49, et cetera. It's every unit being built in the United States, new construction, from 1 unit detached, which is the dark blue, 1 unit detached, which means condos, right? 2 to 4s, 5 to 20s, that's just a category. I used to do 5 to 20 apartment loans when I was a young loan officer. 20 units or greater, manufactured housing. That's everything in these stacks. Right now, if you look at where we are, we haven't had this low a production of available units to move into, rental or owned.
Right.
It doesn't matter, rental or owned. We haven't been this low on a production side in this country since World War II, which is the 1940 to 1949 period. And the reason why we weren't building homes in World War II is because everything, all resources, everything was going to Rosie the Riveter. We were building weapons to fight the Germans. And so look at the past, look at your lifetime to even 2010 to 19, 2000 to 2009, 90 to 99. We were building more than 10 million units a year.
Mhm.
Yeah.
Right now we're building nothing.
Yeah.
And where's the administration on this thing? This is freaking obscene. Granted, we had a pandemic. We shut down the nation. We had supply chain shortages. We didn't lumber length with the $1,600. They're back down to around 600 or whatever they're at today. But we have a problem. And how's this administration handling it? FHA is over here tinkering with an LLPA grid by a bureaucrat who's never been in the mortgage business and has no clue what she's doing. And then everybody fights to defend that action when it did nothing. We have FHA dropping MIP premiums by 30 bips. Julia wanted to go a lot deeper than that, but she was in a battle with OMB who needed the money for budget dollars. We don't have the president even focused on housing. We have actually an inexperienced and under a lack of authority in the hands of the HUD secretary. It's a nothing job anymore. They no longer have the regulatory office, right? They gave that the Office of Regulatory Affairs, which used to report to the FHA commissioner at HUD. I had it. We put in the SAFE Act, as a matter of fact, shifted to this new regulator called the CFPB. The regulation over Fannie Mae and Freddie Mac shifted to this new regulator called the FHFA, which exited HUD, used to be part of HUD, the GSEs regulator until the HERA legislation passed in 2008. So we've got a HUD secretary who has virtually no authority to do virtually anything other than tinker with FHA rates. That's it. That's all she can do. She can't build housing stock. She has no authority, and she's not even really a housing expert. So who else is looking at housing? We have the Bureau out there enforcing actions against lenders. We have FHFA doing literally nothing, in my view. And we have the White House doing literally nothing. We have HUD doing nothing. We have the Fed screwing up the economy by raising rates too dramatically. Treasury's not engaged here. And back in my day, everybody I just mentioned, we all met in a room several days a week. And I talk about it in my article that I've just published. And the secretaries, along with me and everybody else, we met with, sorry, I'm going to share a photo with you guys. We met with the president. Where's my president photo? I'll just show you Obama. Sorry. This was a classic meeting.
I think
This is a meeting in the White House. This is the Roosevelt room. It's the president's conference room. It's right across from the Oval. It's called the Roosevelt room. It's got Teddy and Franklin on the walls. That's Obama with his back to us. That's me across the table. You see, I still had a little more black hair there with the blue tie, searching for something. Now, here I was meeting with the president literally every couple of weeks to talk about housing.
right.
I can promise you,
That's not
Biden has not had a meeting with a guy like me in the room to talk about housing at all. And whatever you say about Obama, he hired a guy from the industry to help be on his team and meet with him all the time to make sure he was doing policy with at least a business sense in the room. And I got great stories about that, which we can't spend time on, but that was then. Now we've got a crisis. We're not building any units in this country. The Fed has completely screwed interest rates. The GSEs are being tinkered with by the FHFA. We have no ARM market. We have no secondary market for jumbo non-agency loans. You're having to sell them all to banks. And the banks are screwing you, by the way, because they're giving a better rate to their own retail group than they are to their TPO stuff. So you're all screwed in terms of giving your consumers the right deal that they should be getting. And that's because we don't have a secondary market for non-agency. So everything I'm laying out, I'm sure you're all shaking your heads going, yeah, that's right.
Yeah, we all totally agree.
But who's
Getting killed on the jumbo stuff. Yeah, we
Well,
just
I mean, forget about.
who's demanding change?
Okay, let's go back to my little cash out refinance. This guy's owned his house forever. He's doing a
Yeah.
cash out refinance. He has 2 5/8 in LLPAs. He's got a 718 score. It's not 620. And we're doing 75%. It's not like through the roof. So he's got a ton of equity in a presumably appreciating market still, even if it was, it's the numbers are all pointing towards that. So again, like risk-based 2 5/8 hits on the LLPAs. That is ridiculous. And so again, why should we know about this stuff as LOs? Because it impacts us and our clients every single day. So I just want to take us back a little bit while everyone takes a little breather here, because that was a lot. A collective
Sorry about that.
cleansing breath. Don't be sorry. Are you kidding me? It is so much coming at us every freaking day. So here is back to our little friend. He says, now LLPAs are politically based, which 100% but that's another topic. He'd like to know what the given level of risk is converted to an adjustment and fee. We all know that non-owner is riskier than owner occupied, but how does the increased default of non-owner equal 2 3/8 points? So is there a direct line? Okay, thank you.
Okay, so any of you old school guys, I'm been in this business 40 years. So I ran Freddie back in, starting around 2000, just before that. And we charged 0.5 point for investor properties. That was it. We had a flat fee across the board, nothing like you're seeing today. I mean, honestly, nothing. We had no additional charge for second homes, which, by the way, adding that fee to second homes, it screws places like Lake Tahoe. I mean, these are communities that support mom and pop businesses, local restaurants, home builders, house cleaners, people trying to get by who get work from the people who buy homes up there.
Right.
I just don't understand why
It's,
this Democratic administration can be doing all this stuff to hurt America's home buyer.
Because
It just makes no
that's
sense.
the disconnect.
It-
They
it really
just
devastates
really
those
don't
taxpayers.
understand it at all. They don't get it. There's
Right.
no connection. We had a really good comment from somebody who said cash outs are also a tax-free, no cost to taxpayer stimulus. I thought that was interesting. I hadn't even thought of that, because he's right. If you're doing a cash
Well,
out refinance and this money's going into the economy, that's not the government having to do it. It's just happening naturally. So that's.
Well, you know, one of the things that when I worked in the administration, we had a rule about a small business. Like we gave preferential contracts to anybody who was part of the SBA, the Small Business Administration. It was kind of a pain sometimes, because sometimes I wanted to award really big contracts to companies I thought would be better. But the administration had like a specific intent to help small businesses.
Mhm.
Where do you think small businesses, if you're a small shop in your community, you're a dry cleaner, you own a small grocery store in the corner, you own a small restaurant, how do you stock your goods and your services? You try to get a line of credit, although Wells Fargo just shut down all their lines of credit and shut everybody off literally overnight. You guys know this if you're in California, and got rid of all their lines of credit. So where else do you do it? A lot of people will do either a HELOC, or they'll go out and do a cash out refi, take that chunk of cash, and they'll hold it into a reserve account, their business account, and they'll use that to tap into, to supply their, fill their counter space, sell the goods, replenish the cash, and then be able to go restock. And this is how small businesses across the nation operate. And they're on every corner, they're massive. And so, you know, when we make moves that hurt, like cash out refinancing, like it's evil, or it's only going to rich people, I just don't understand this. In fact, rich people aren't getting cash out refis. Trust me.
No, they're not.
I've had 15 homes in my life. My equity is huge, and I have no interest in the cash out refinance. People who get cash out refis do it because why? They need it.
Yeah.
And
Either
we're
need to pay
screwing
off credit
people
card
who
debts,
need help.
or they default, or
Yeah.
they,
Yeah. And not even default, Kevin, necessarily. It's just a matter of, you know, getting them to get through a period. As we all know, and you guys know this too, a lot of first-time home buyers that we put in the homes the last couple of years, because of inflation, suddenly the cost of goods and services, from gas to milk and eggs, all went up. And, you know, their childcare went up because of labor shortages, and everything else has gone up. Their cash position, their net cash flow after expenses, has dramatically contracted. And so, you know, we have to think about society
Right.
when we're making policy here. And nothing I'm saying, guys, costs the taxpayers a dime. We don't need any bailouts at all. All we have to do is stop being jerks by allowing the regulators of institutions like Fannie and Freddie from ripping off consumers needlessly when they could use some help. And we also need someone to put some common sense into the Federal Reserve, because they've overcorrected already. They've overcorrected. And for Powell to say in testimony that there might be 2 more increases, are you frigging kidding me, you jerk?
I know. I know.
So-
Well, I really think that we're at a point where, so I have a theory, you know, we've got Fannie Freddie, who so desperately want out of conservatorship, but the only way they can get out of conservatorship is if they have a mountain of money in reserves. And to
But
get
then
there, they've got to rake everyone over the coals. And so they are like the only entities in the industry in the last, year and a half, who have made a dime, let alone they're making billions still. And so the fact that that is just running amok just absolutely drives
Well,
me
just so you know,
insane.
I published a piece before the one I just published yesterday, suggesting that Fannie and Freddie should be released. Everybody was
Yes.
like, "Holy crap!"
We were gonna get to that, Mr. Stephen.
But and I do believe they should be released. I got a lot of pushback saying, you know, they don't have the capital to do it. And look, in a Housing Wire article, I can't write a thesis, but there is capital to do it. And there's 2 ways you can do it: structurally release Fannie and Freddie. And I'll give you both. One is there's an explicit line of credit that's already been pre-funded. It was funded back in the Obama administration. It's $250 billion. It's their line of credit. It's being used as an alternative to capital, and it was provided to them. that could be assigned as capital in exchange for ownership from a stock standpoint of the two entities, or in exchange for what we call a commitment fee that was envisioned in HERA, a commitment fee so that in exchange for getting the $250 billion in capital that sits there right now in the Treasury coffers, it's literally sitting there today, they would pay a fee in addition to the government every month in return for that commitment of the $250 billion. That would give each of the entities, you wouldn't split it evenly because Fannie needs a little more than Freddie, but nevertheless, you'd split up the $250 billion, and that gets you a long way. Then you could do an IPO, because if they infuse that much capital,
Right.
you're going to get a lot of investors like Ackerman and Paulson and others who are sitting there wanting to get in anyway, already own a bunch of their stock, who would come back and come in. That's one way to do it. The other way to do it is what's explicitly written in the HERA legislation from 2008 that put them into conservatorship. And it talks about putting them, how to exit conservatorship. And another pathway is actually to put them in receivership, which is technical bankruptcy. It's a weird pathway. It could freak people out, but you put them in receivership, you create what's called LLREs, limited life receivership entities. That's a legal term that can last for 5 years. And then in that 5-year period, they restructure an IPO out the backside as de novo companies. So these are both legal solutions. Now, people are going to say it's too complicated. Yeah, they're both complicated.
So it's like,
It's all complicated.
These are big ass companies, but they're there, and they've got the 250 billion line of credit sitting there right now. And again, it was fully funded by taxpayers a decade ago. So that's money has already been there. It doesn't cost anybody a penny just to convert that to GSE capital as part of their release with a commitment fee being paid back. And you could even include some percentage of profits if profits exceed a certain percentage. You can have all this threshold stuff. But it isn't, I'm rattling this off because I've worked in groups, in think tank groups in Washington that we've thought about this for now 15 years or whatever it's been. But this is the way you can get out. So for people to say it cannot be done, they're wrong. It just takes leadership. And the problem we've got right now is the president doesn't give a damn. Granted, he's got a lot of things on his plate, but nevertheless, this administration is not spending a moment on this subject, not a moment. And as I said in my article, while Nero fiddles, Rome burns, and that's what we got going right now. So
yeah, it is. To say it's frustrating is beyond. We had somebody who sent in the link to your article. I think you have to log into Housing Wire to access it. I'll see if we can figure out how to get it so we can embed it in the YouTube in recording that we'll post in a few days. So good grief. So, okay. So thank you, by the way, to Charlie who sent that in.
That was
Appreciate
good.
it. What?
That was good.
It was good. Okay. So there is an obsession with making sure that we are lending to minority borrowers. And we just had a article hit yesterday. There is a lawsuit that Change has false. It's allegedly. I want to be clear. This hasn't been proven in court yet, but Change has been accused with falsifying their CDFI information. So to be clear, this is the Community Development Financial Institution. There are only 3 companies that are authorized to do these loans: Change, Champion, and Quantic. And so the lawsuit was filed by Adam Levine, who is their chief of staff, which I thought Adam Levine was like the lead singer for Maroon 5, but apparently I was wrong. He is actually working for Change Wholesale. And so what's happened though is they're saying, so Change has said that they had funded over $25 billion in loans to more than 75,000 families. And over 70% of its loans have been to Black, Latino, and low moderate income borrowers and communities. He's saying that the company is mischaracterizing the race, ethnicity, and income level of the borrowers. And the person I spoke to yesterday, who is on the inside track with that whole situation, said that they were labeling the loans this way because Wall Street will pay more for them. So I'm not clear on exactly why Wall Street wants to pay more for loans that I don't know. Like, I mean, are they good investments? Are they riskier? Are they not? Like, do we have any analytics on all that? And as a whole, I feel like we need to be fixing the mortgage industry.
So a couple things. One, I'm not going to talk about change. This thing will work. We'll learn over time what that is. I mean,
Wait,
one thing is at the end.
Wait, back up. Say that again. We're going to fix it.
No, we'll learn what happened.
Oh,
here
all that.
over
Yeah,
time.
yeah.
I mean, when I ran the MBA, if I got after everybody who called me and they were complaining about one of their competitors or some other lender, I don't, so sometimes we got to see how this stuff plays out. But I will say that there's a huge specified pool market for low bow minority loans. And people are getting huge trade-ups for them. Guys like Gary Cipineri, I don't know if you know these people, former JP Morgan, but anyway, there's a lot of strong capital markets guys who do nothing but trade pools of low bow. And a lot of that'll be in CDFI trades. So
why?
Because it tends to focus on underserved communities.
So they're literally
it's all in the community development space. I would be surprised if they would misclassify ethnicity, but I'm not going to comment. I just want to see how this stuff rolls
Oh, so
forward.
you don't think it's true?
But there's a huge market. There's just a huge market for this. In fact, if any of you guys are in capital markets right now and you work for a decent sized mortgage banker, even the GSEs right now are using their cash windows to buy what's called LIP and VLIP loans, low income property, low income borrowers and very low income transactions, because they have to hit their own goals that the GSEs set on, but that's competing with the spec pool market for that same space. So there's no doubt that, having access to being able to trade and transact in a pool of stuff that may be rich with that low bow stuff can be a profitable business. But if they're miscategorizing ethnicity, that's not going to end well. So we'll see how this goes playing forward.
We've been laughing about the choice of acronyms that they are using on those two programs for a couple of weeks here. Because I mean, LIP and VLIP, how do you even have a straight face and have that conversation in a meeting, for God's sake? But anyway,
and yet they do.
But
I have no idea what you're talking about.
So we have a comment here. Why aren't Congress representatives who are in the Housing Committee talking to you to apply your perspectives into legislation? That's a great question, isn't it? And
I just spoke to your favorite Congresswoman's housing person from LA, Maxine. Aaliyah Fierro is her housing person. And as you know, all kidding aside, whether you love her or hate her, Maxine did chair the House Financial Services, and right now she's the ranking member of the committee. Aaliyah's good. She's wicked smart, and she tried to get some legislation done to help first-time home buyers. The dysfunction of Congress is the most remarkable thing I've ever seen in my life, and the reality is that legislating, I don't think, is a solution. Not unless you can create a national effort. After World War II, when the New Deal was completed, there was a national scale effort, and we built communities across the country.
And that's what we need.
Yeah,
I mean, you look at that chart you had.
Thousands of homes. Most of them were whites only communities, but we built thousands of them. And we need some kind of national effort in that regard to build units. Even the FHA, the HUD secretary, Secretary Fudge, she made a great speech about a year ago about wanting to put an intense focus on manufactured housing. And as you just all recently read, they have created the Office of Manufactured Housing. I'm not sure what an Office of Manufactured Housing will do. There was always a head of manufactured housing that worked at HUD when I was there at FHA, but that's fine. So they created an Office of Manufactured Housing. The question is, how are you going to build it, and who are you going to get to finance it? Because as you guys know, getting a loan on a manufactured home becomes very limited, and that's a challenge. But manufactured housing today is not a 12 by 40 aluminum sided
Right.
structure sitting on some cement blocks. You know, these are really nice Lennar, whatever properties that are built, you know, they're built mostly in a factory, but they're wood framed and they look nice and they'd be great entry level housing. But again, no effort, just no national effort.
I have to say that my conversations with FHA give me much more hope that they are really, like, they are trying to listen, I feel, to industry and trying to take feedback and really working hard to incorporate that into what they do every day, which is the exact opposite of what I'm feeling from our other friends. But
yeah, it was interesting. We were really pushing for Sandra Thompson to.
I think that's part of why I'm so upset is I was so excited. And the first thing she did was get rid of the half point that was close, fee. And it was, you know, like I had high hopes for her.
The COVID fee.
Have it go crashing to the ground like this. It's just disappointing.
You know, I do think there's I mean, Sandra, who I've known for a long time, but she's been a Washington bureaucrat for 25 years. You can look her up on LinkedIn and see her profile, and worked at other federal agencies, never been in housing. The one advantage we have over at HUD is Julia Gordon is a well-known inside the Beltway. She's been in housing policy. She's been in housing policy forever. And she's always been, even though she's a real lefty, she's been always considered by business folks as one of the rational voices on the lefty side when it comes to housing policy. So when we fought on the qualified mortgage rule and we wanted to get that safe harbor in, all the liberal groups didn't want a safe harbor. In fact, I'm not going to name her name, but anyway, a well-known activist said, I want every lender to have to defend every foreclosure in court.
Oh my God.
Because they didn't want a safe harbor. It was really Julia and one other guy who came to the table and said, and told Cordray, who was running the CFPB at the time, that she supported both the DTI as well as the safe harbor part of the rule, which was critical for all of us to underwrite loans for many years thereafter. So she knows policy, you know, she's not a mortgage person per se, but she definitely is more knowledgeable than Thompson is. And so her ability to get stuff done at HUD, she has a vision, she knows what she wants to accomplish, and she's trying to work it. And so, you know, good for her. Elena is also the same over at Ginnie Mae. Elena was with the Urban Institute for many years and worked on housing issues out of the housing center. So not as brilliant, I don't think, as Julia, but she's still, you know, understands the business, unlike the disappointment that Sandra's turning out to be.
Yeah, disappointments being kind for sure. So the question is, do you really think that the government wants to lose Fannie and Freddie and release them? And the answer, in my opinion, is no. But what do you think about that?
Well, I think liberals, Democrats, like having Fannie and Freddie as a tool to achieve housing objectives. They don't know how to use that tool, which we're seeing right now with those LLPA changes.
Yeah.
That is such a dismal response to trying to improve minority housing. But nevertheless, I know they like having that tool. The Republicans want to kill Fannie and Freddie. So Calabria was on a path to kill Fannie and Freddie. And I'm sure any of you knew that.
Yes.
Definitely that capital rule he implemented, which has been pulled back on, but that would have crushed the GSEs. I think he's the one who put in some of the fees on 2 to 4s or second homes. I don't know.
Yeah,
if
he was not a fan. He wanted it gone.
But his whole intent ultimately was to literally, I have testimony from him before going into that job when he was with Cato Institute, testifying how you get rid of Fannie Mae and Freddie Mac. And he thought essentially you cripple them so badly by limiting loan limits, raising fees and costs, that you make them you make it such that the private sector will ultimately come in and price through them because they're so out of touch. Now, I'm not going to go down that rabbit hole, but so we had really bad directors on both sides. And unfortunately, neither I think are good. That's what worries me. If Trump comes back in and puts a Calabria back in, that's a problem. And if Biden stays on and we keep Sandra, that's a problem. And so that's where I come down with, we need everybody to start saying, we got to get these guys released, because if they're released, just so you know, the FHFA director becomes only the director of the GSEs, not the conservator. Sandra is the conservator of Fannie Freddie under the conservator agreement that brought him into conservatorship in 2008, and her authorities are huge as conservator. She basically runs their boards of directors. If she was just the director, she'd be simply their regulator, and it would be nothing more than a safety and soundness regulator. She couldn't be forcing them to do some of the wild crap she's doing now. So release from conservatorship is really the only answer.
You know,
it's our future.
It was the pandemic and the CARES Act that made me think, okay, thank God for Fannie and Freddie. They were the only entity who was like sanity during that whole thing. We kept, you know, at least the conforming market going for a bit. And now I'm like, God, maybe they're useless. Like it feels useless. So when I'm talking to Bill Dallas, who we're going to have on in a few weeks again, it is, you know, and he's talking about, we need new products. We have one product. We just have the 30-year fix. We have 8 million ways of doing it in just one product. And he's right. We do. And you agree with that. You said that we need more products. With that being said, I just want to, we got to bring this up a little bit because we're getting towards the end. Dr. Lawrence Yoon, chief economist for National Association of Realtors, who was our esteemed guest a few months ago, he noted that only 2% of home sales in America are distressed in May, which means that they are in foreclosure or some version of foreclosure, which is near historic lows. So it might be double from last year, which is at 1%, but it is really historic lows. So, and in 2008, 2012, as Dave, I'm sure remembers, there were a third of all the home sales were distressed and there were no buyers. Now we have so many buyers, too many buyers, and not enough inventory. And the converse of that is in Britain right now. They're in trouble because, so that's where my conversations with you and Bill Dallas, I'm really interested in, like, where do we find the happy medium between a 30-year fixed and every time the Fed changes the Fed funds rate, the mortgage rates go up or down like it does in Great Britain, which is happening. And now they've got all, you know, so many people in default. It's not even funny. So, you know, it's a crisis in the UK. So where is that happening?
By the way, I when we talked about that earlier, I pulled up a couple articles. I'm an expert witness in that big realtor case, the $40 billion, both cases. There's two of them. And I'm going in for my deposition here in a few weeks. But I'm on the realtor side, and I'm not going to go. That's too long a discussion. But they're using the plaintiffs who want to basically make it impossible to cover the selling agent's fees and the real estate commission. That's really what they want to stop, which is crazy. I mean, imagine
you have no more.
How are you going to look for a home? And they use Australia and England as markets that don't have selling agents. The problem is in Australia and England is they have terrible access for home ownership, especially for minorities who have to go to work every day and young first-time home buyers and can't take the time to go call each individual listing agent and pre-shop and tour the homes, which is what a selling agent does.
You lost Audrey there.
Audrey, we lost you.
To be in the middle of selling a house in Wales at this very moment, and it just blows my mind of like, what the heck are you?
But I do think, I mean, someone said that we need a conventional arm market, and one of the problems we've got, guys, and this is part of the GSEs being in conservatorship, is back in the day we had a portfolio. Now, granted, the portfolios began to have some problems. But the GSEs were really dragged into the housing crisis because of the subprime collapse. But they had portfolios and we could make markets. We literally could go out and make markets. So as the head of single family, which was my job, I would work with Byron Boston and Gary Kane and the guys who ran the portfolio. And we'd come out with 50 billion to buy hybrid arms. And they liked hybrid arms in the portfolio because you could interest rate match them really well. And so we could get a government wrap on a hybrid arm. The problem is the GSEs don't have a portfolio today. They're not allowed to. And so they can't create markets. And so what you guys have in front of you is they have an arm, but they have no market makers to create an arm market on the secondary market side. Unless you have a huge pool with interested buyers on the back end, you're just not going to get into that market. And unfortunately, as we saw with like Silicon Valley Bank and Signature Bank in particular, they got really into buying 30-year fixed rate mortgages because they thought that was the best return they were ever going to see in their lives. when in fact that buried them. But
Yeah.
I think there are ways to bring an ARM market back, but it's going to require the GSEs to be released from conservatorship because you need a market maker to be able to do that. But Audrey, to your point before you jumped off, I'm a big fan of ARMs.
I didn't jump. I was shoved.
Yeah, so I'm a big fan of adjustable rate
Behind the
mortgages.
scenes who's cutting her off.
I'm a big fan of ARMs. You know, I sold monthly adjustables. I worked for World, and I'm not going to go through a process of defending that product the way it was back in the original day, but ultimately it got abused with really deep discounted teaser rates and had tons of neg am. And then Countrywide did them at 100 LTV with an 80-20, and the 20 was backed by Countrywide Bank. So it got to be a really crazy market, as we all know, prior to 2008. But there are really good ARMs that could really help buyers today. And you know, whether it's a 5 or a 7 or a 10, that's gonna, you know, that can be a really safe product. And the reason why I say even a 5 is, yes, you could get a spike. We used to call it a bullet in secondary in capital markets, because when it was coming up near the 60-month mark, you were wondering what the bullet hit was going to be and whether those loans would all prepay. But you can do a 5-year for a borrower today, qualify them using today's debt to income ratios. If they only get, you know, a 3 to 5% raise every year, they can stomach a pretty big hit on the 5-year adjustment period, 60 months down the road, because they will have had a 10 or 15% minimum increase in their wages and likely more. So, you know, there are safe ARM markets, and it's another thing that the administration and the housing policy leadership is not doing today, because you can make markets. There are market makers that you can ask to make markets. The administration could literally go to Goldman Sachs or JP Morgan, put up a backstop, create a line of credit, and ask them to make a securities market. You know, these things are all kind of fixable.
I think
you know,
I
nothing's
think we
easy
need to-
in anything we do, but this stuff is all fixable. And what we don't have is focus, and focus is the name of the game right now.
I think that, I mean, what I would like to see is I'd like to see us refocus on really risk. I mean, really, like, is someone going to repay their loan? It's so secondary to, can we sell it and offload any liability we might have at some point? And I mean, can somebody afford their mortgage? Can they pay the loan? Do we really want people in housing, or is it just a bunch of BS? Which that's how it sounds at this point. And then us as LOs, like, we got to get over this whole rate thing. I mean, the vast majority of LOs that I talk to, all they think about is, oh, when the rates come back.
So Audrey, I have to interrupt you. You got asked a question this week at a fair, and someone asked you, hey, what's your rate? I want to hear what your answer was.
I may or may not have said straight to a stranger's face, that is a really stupid question in this market, because, and I went on to explain to them that we shouldn't be focused on rate. We should be focused on, can you make your payment? Are you going to cash flow on an investment? I said, and he goes, well, I really want 4%. I said, so you're going to die poor because you're not going to buy real estate waiting for a rate that was a unicorn. And so you're going to just rent the rest of your life? I mean, oh my God, I'm so over it. I can't even tell you, cannot tell you. So yes, we need to shut that down. And frankly, Dave, it starts with the regulators who are like, oh, shop for the lowest rate, shop for the lowest rate. That is a bunch of hooey, because we are working hard to get these people's credit whipped into shape. We're strategizing with them. We're doing all sorts of things that we don't get paid for. After the loan closes, I spend 3 days on the phone with my clients who need some help getting their impound account straightened out. Do I get compensated for that? Hell no. Do I want to do it anyway? Yes, I do. Why? Because that's the right thing. But do I want some regulator going, oh, well, you've done all this, but yeah, go shop for your rate? No, pisses me off. I'm so sick of it. But
let me end with one thought for you, Audrey. Okay. Guys, first of all, I saw someone say rates are not coming back. Rates are never going back to 2. Rates will be at 5 by January.
Maybe if we're lucky, maybe
they'll be at 5, 5.5. Anyway, there's a great Forbes piece that just came out. It quotes like every economist that anybody follows, and everybody knows that the Fed always overcorrects
Yep.
Following the correction, there's a rally in rates, and the Fed is just about done, and we're going to see rates come down. You know, when the spread between a 10-year treasury and a 30-year fixed rate is 300 basis points, that's abnormal, and that spread's going to contract. So, but let's not worry about rates, because in the end of the day, rent the rate, you can always refinance them. And that, you know, whether they go down or up, it doesn't matter. Lock them in today. If they go up, they're protected. If they go down, they refi. But for all you guys, I just want to remind you that this is the population of the United States. This is from Moody's. It's a presentation by Moody's Analytics, their chief economist, Mark Zandi. And this is the entire population distribution of Americans in this country. The red bars are the millennial generation. And he circled those key red bars there because the median age for first-time home ownership in the United States is age 34. That's fact. Federal Reserve tracks it through IRS data. They publish it every month. It's age 34 is the median age for first-time home buyers. If you look at age 34-year-olds today and look at every cohort younger than them, 33, 32, 31, 30, even going back a decade to 24, every cohort, everybody moving into the peak age for first-time home ownership is equal to or larger than the current one. And so you've got a huge wave coming your way. So Mike Fratantoni, the chief economist of the MBA, put this slide together for a presentation he just gave a couple days ago. And the left is the same slide. It's crunched together, but it's the same picture, right? Huge population coming our way demographically that want to buy homes. But look to the right, the median age, this shows the average age for, the home ownership rate in America by age. The gray line along the bottom are people under age 35. As I said, the median age for first-time home ownership is age 34. So it's really not till they get till 35 or above, they start buying homes. So it's very low. Look at the yellow line just above it. That's age 35 to 44. It leaps. So, I mean, the reality is all this depression that we feel right now is because Powell's trying to slow down the economy and he's pointing at housing as his number one attack plan. But guys, rolling your way is the biggest population wave, not just in a long time. This is the biggest population wave in American history. We've never had a wave this big. Even the baby boomers weren't this big coming into their first-time home buying years. And you're on the front doorstep of that wave coming at you. That's why I'm so pissed off that the administration isn't focused on housing units, because if you think we're in trouble now, it's only going to get worse. But everybody talks about like home prices are going to go down in a major way. Wrong. And everybody says rates are going to stay this high. That makes no sense. You got to understand the history of the Federal Reserve's actions. This is a temporary moment in time. We're not going to go back to 2, but we're not going to be at 7. So
if rates go in the 5s, it's going to take off like crazy.
Oh, it's going to be on fire. I mean, I think right now, anybody who can go buy a house today is making the smartest decision in their lives, because they're going into a period of negativity.
Absolutely. So we're going to end with a comment that I just got from a listener who said, what a breath of fresh air. Mr. Dave Stevens and you to our, oh, that's nice. Standing ovation to today's webinar. People really appreciate this kind of information. And just to give you something to put in your video that you're going to post at some point this week, because you're not a lazy LO waiting for everything to get back to 2%. The average days on the market for purchases or for sales, 18 days. That is a seller's market, kids. I mean, it is smoking out there. Get your buyers out there. We have 2.5 months of inventory nationally. We haven't had this low in inventory since the 1950s. It's, it's just incredible, the market. It's tough, and it's too much competition, and you have too much margin compression, but that's taking care of itself, guys. A lot of loan officers are exiting this business, and they're going to continue to do so. And companies are exiting the business. It's not depressing. It's opportunity. So get it together. Okay. You're going to miss us yelling at you next week because it's 4th of July. And so we can't see you on 4th of July. I don't think you're going to miss your, singing the Star Spangled Banner and hot dogs for us. So we will see you the following Tuesday. And that'd be July 11th. Holy guacamole. Dave Stevens, we love you. Thank you so much. The thank yous are rolling in, and everyone really appreciates your information.
Be glad to do it again for you guys.
Fine. Get to work. Okay. Bye, kids. Have a great week.